Hello and welcome to this video where we're going to be discussing what lies ahead in the financial markets this quarter. We're only a few weeks into the new year and volatility has picked up from where it left off in 2025. We've already seen big moves across major asset classes, including FX pairs, gold, silver, and stocks. So with me today to discuss these moves and what to expect moving forward is Stavros, our market analyst at ThinkMarkets. And he's going to brief us on everything that's likely to unfold this quarter, as well as the potential opportunities that lie ahead. So, Stavros, I want to kick off our discussion with earnings season. JP Morgan kicked us off a couple of weeks ago while Netflix reported last week. But this week is the big one with most of the major tech companies reporting. As we know, earnings season can create a lot of volatility. With the stock market currently close to record highs and people concerned about a potential bubble, particularly in AI stocks, investors are understandably a bit on edge. I think people are anticipating strong earnings, but what they're more concerned about is the guidance. If that's weak, that could place downward pressure on stocks. So I want to know, how do you see it all unfolding?
Yeah, this is true. The unofficial earnings started with JP. Then we've also had one of the FANGs report in Netflix last week. But the most significant, I would say, because we are currently looking at this rally being driven really by AI sort of optimism, right? So we've had TSMC reporting, and TSMC really actually recorded a record profit, 35%, if not mistaken, plus, and soaring AI demand. But then we had Intel reporting, and Intel beat earnings indeed, but the stock fell about 15%. That was because they actually guided the markets on a very weak footing, which means future guidance, of course, was weak. And this is one of the risks that we also talk about in the Q1 preview when I've put together back in December of last year. And the reality is here stark. On the one hand, you've got the TSMC proving that demand is there. Intel kind of also shows that there is demand because obviously they beat estimates, but they also showed that there are high costs that are crushing margins. And this is something that we really need to pay attention on, especially this week, because you've got most of the Magnificent Seven stocks reporting, Amazon, Meta. So we need to see whether one, demand is sustained through these reports, but most importantly, whether the companies can really get profits returning back to them quickly as markets expect, rather than just that being pushed down the line, because this is something that is very important. This is what actually caused the crash in Intel as well. And currently, let's not forget that we are really at a very high valuations when it comes to the Magnificent Seven. I think we are around 30x in terms of PE. And when you look at the rest of the markets, we're looking at 21x only. So this big gap, okay, might be realized if these stocks don't perform as markets expect. And that's just to make that note again, it's not about just beating estimates. It's also about justifying that the high costs are actually going to return good margins for these companies. Because if hyperscaler demand remains high, but the costs accelerate, that's going to be a very risky situation for stocks that, of course, will have other things to deal with currently that relate to risk on and risk off sentiment, including tariffs, including the situation with Greenland, things that, of course, we couldn't predict, some of them back in December, but now they are things that we need to take into consideration seriously. So the thesis remains the same, to be honest. Valuation risks are high. Valuations are high, and the risk of that is also high. TSMC showed that demand is real, but on the other hand, Intel showed that profit margins are very fragile. So the Magnificent Seven earnings this week will decide which narrative wins, and that could essentially, crush the markets 10, even 50% over a period of the first quarterly reporting sort of period, let's say.
Okay, interesting. So speaking of another potential threat to tech stocks and global markets as a whole, this Friday is the continuing resolution deadline. I know last week the House passed the funding measures, which means we may avoid a government shutdown again. But could you tell us more about this? And is it something traders should be watching closely?
Yeah, this is also something we flagged back in our December report. Obviously, considering that we had the longest shutdown last time around, 43 days on record, right? This has affected a lot of economic reports, including the Fed reporting, inflation reports, and really adds uncertainty into the markets, right? Now we are heading into that deadline on Friday. We are halfway there because the House approved the bills, but the Senate hasn't. And the primary reason they haven't is because there is a lot of debate and arguments about homeland security following the recent shootings in Minnesota. So the House passed 1.2 trillion package, okay, but it's this stuck in the Senate, and we really need to see that going through over the next 4 days up until Friday, right? So it's very likely until that gets passed, volatility is going to be high, okay? And what else we also need to take into consideration, right, is that Trump faces more than just that vote, okay, at home. It faces more of a tariff reality. There is a court that is still pending about whether his tariffs are legal or not. And why I'm mentioning tariffs, because they actually affect how the US economy is progressing, performing. Now, if the funding bill, for example, let's say isn't passed, right, and then we get a shutdown, this is going to affect the US GDP growth. And while we'll have tariffs uncertainty as well, then we might have a double whammy potentially for the US economy. And we are talking about stagflation risks, something that we also talk in our December report. There is a lot of escalation on that front as well, right? Recently, we saw Trump threatening tariffs on Canada. Some would say it's because of electrical vehicle loopholes, but the reality is that that follows Mark Carney's Davos speech and a potential trade deal with China. And then obviously, the January 30 deadline is on Friday. So this remains a very short-term risk that we have to take into consideration. White House has passed the bill, but the Senate is tight. So combined with new tariffs on Canada, the inflation fear is back on the table.
Okay, great stuff. So the final topic I want to touch on is the policies of central banks.
Yeah.
There seems to be a bit of divergence between central banks currently, with the Fed continuing to cut rates, the ECB being stuck on hold, while the Bank of Japan is likely to hike rates this year. So, how do you see things playing out this quarter and the effect it may have on the markets?
Yeah. Back in December, the Fed cut rates. And given that timing, the sentiment and market expectation was for the Fed to continue cutting this year. The ECB hasn't really changed their view. They're not cutting, and that is to be considered at least more hawkish than the Fed. Then you've also got Japan, which are likely to hike, but they're dealing with other issues at home, political issues. So nothing really has changed from back in December, apart from a very critical point. I would say that the Fed has become a bit more hawkish. Okay, and that is since our preview, of course, markets expect the Fed to pause, and that is on Wednesday. We have the first FOMC this year, right? Instead of actually going into two or three cuts, and we have one cut priced in now. If I'm not mistaken, that takes us to June, right? So this divergence that we were talking about back in December, at the end of December, has has tightened a little bit, okay? But that doesn't necessarily mean that we're going to see a change in the dollar, because as mentioned earlier, we have new geopolitical events that we need to take into consideration. And the tariff escalation and threat towards the European and other countries, and actually specific countries, I would say in Europe, for Trump's ambitions over Greenland, is something that has triggered a large de-dollarization trade. Or this is what currently actually is pushing the dollar down at the same time. And that happens, dollar being considered a safe haven, right? While in Japan, we are also dealing with fiscal risks because the new PM is considered to be a fiscal hawk, let's say, or you can call it she's dovish. She's actually pro stimulating the economy, and this adds a new element of fiscal risks in Japan. Given, of course, we have also the snap elections next month, right? So considering that the two primary safe havens currencies, at least the USD and the Japan, are kind of off limits, right? A lot of the traders are focusing on the more stable safe havens. That includes, of course, gold. The more high risk seven haven alternative, which is silver. We see their prices both at new records, even this week, 5.1 thousand and 110 for silver, all around that level. While at the same time, we see the dollar falling, and Japanese yen is under severe pain, I would say, despite the fact that there are rumors that the Japanese government is finally going to intervene. I think any sort of pullback for the Japanese yen might be short-lived. But back to the initial point, the divergence was weaker back in December than it is now. But fundamentally, although the Fed is pausing, right, and the ECB, let's say, is kind of a bit more hawkish, even along with Japan, we are not seeing any fundamental change in how the dollar is going to perform because of that fact of the dollarization trade. And that is something that is reinforcing one of the trades, high conviction trades I talked about in our preview, favoring, of course, the Swiss franc over the yen, CHF, JPY.
Okay, great. So we've touched on some of the key things to look out for. Now, I wanted to ask, what are the major opportunities ahead and how should traders manage their risk this quarter?
Yeah. Well, besides the cyclical sort of opportunities that we see in gold and silver, they are both overextended, okay, without that meaning, of course, that they are going to suddenly just like reverse. In my mind, this is a long-term, long play, if that makes sense. But for those who are a little bit more worried about how overextended markets currently are, and perhaps those who are a little bit more concerned about the AI rally as well, I would be looking to more of a sort of barbell strategy. These positions a trader in gold, perhaps even also silver, as well as some selective participation in value stocks. So since in the UK, for example, the FTSE is not considered to be driven by AI, right? Sentiment at all. Actually, this is just probably a US thing, given how big the tech sector is in the US. I would just probably say selectively going into particular stocks in the FTSE or also the index itself. On the one hand, you've got, of course, the gold that is the ultimate hedge against fiscal chaos and the dollarization itself. But on the other hand, for those that feel a bit more like, it's overextended, a rotation to UK FTSE 100, cheap stocks, I would say that they're looking at the PE ratio at 10x or so. So they look a bit more undervalued at the moment, if that makes sense, versus going into expensive US tech. So yeah, that would be my current playbook, to be fair, along with the of course CHF JPY long trade, which has been reaping rewards since being opened back in December.
All right, great. Okay. I think that's everything for this video then. Thank you, Stavros, for your insights. I thank you to everyone for watching. If you found this video helpful, then be sure to subscribe so you stay updated on all our upcoming videos, which I'm sure you'll find valuable. Thank you and goodbye.